Manish Chowdhary, Director Equity Research, Banking and Financial Sector at IDFC Securities now joins in. Manish, hi, good morning. First up, what's your call on ICICI Bank? What kind of expectations do you have?
Okay, in terms of the expectations, we expect a reasonably healthy profit growth this quarter. We are expecting a profit of about 1260 crores, which is up 15% YOY. This should be backed by about a 16% loan growth, as well as some uptick in margins of about 5 to 10 basis points over the previous quarter. So expect margins of about 340 basis points, and asset quality should remain stable. So overall, we would expect a healthy quarter. We have an outperform rating on ICICI Bank, and we will continue to have that view as of now.
Okay. Manish, what is your estimate on restructured loans as well as slippages for ICICI Bank this quarter?
Slippages we expect will be largely flat in line with the previous quarter, whereas restructurings could be slightly higher. So we are expecting slightly north of 2,000 crores of restructuring in the fourth quarter.
You know, they had mentioned in the previous quarter that they have a pipeline of 3,000 crores of restructuring, which was guided by the management. So if in case it is around 3,000 crores of restructuring this quarter, would it be a disappointment for the street? Is the street working with an upper limit of 3,000 crores, or is 3,000 crores going to be a disappointment and 2,000 crores might be what the street would be okay with?
I think somewhere between 2,000 and 3,000 is what the street is looking at. Remember that the total pipeline of 3,000 crores what the management indicated may not exactly come through in one quarter. It could be spread over a couple of quarters at least. So somewhere between 2,000 and 3,000 we believe is a fair number to work with.
Manish, what's your call on Yes Bank after the numbers? This is one stock where there's a bit of a dichotomy, or rather there's split view in brokerage community. What's your in-house call?
So we have a neutral on Yes Bank. We believe that the numbers have been pretty good and asset quality is held up pretty well along with the profitability. However, our view is that Yes Bank will continue to be leveraged to a higher growth environment as well as to a lower interest rate environment, both of which we believe will take time to improve. And for the longer term investors, we believe it is best to wait for more visibility on economic growth going up, as well as interest rates outlook changing. So for the extent for the near term, we continue to maintain a neutral on Yes Bank.
Okay. What about Axis Bank? What are you expecting on Axis today, also in terms of asset quality, slippages, restructured loans?
On Axis again, in terms of asset quality, we believe it will be a relatively stable quarter. Slippages should be similar to what we have seen in the previous quarter, that was the third quarter, and so on for restructuring as well. In terms of profits, we are expecting a relatively muted quarter. We are expecting about a 13% kind of earnings growth for the quarter, whereas margins should actually start moving up again. So we are expecting net interest margins to move up to closer to 380 basis points from 370 last quarter.
Do you think that the net interest margin improvement that we've seen in most of these private banks till now, and you're talking about that even for Axis, is sustainable going into FY15? Say, for example, Yes Bank improved to 3%. We have HDFC Bank, which jumped 20 basis points sequentially as well.
So there is some headwinds on margin improvements. Most of the margin improvements have really come from the easy liquidity environment that we saw in March, despite it being a seasonally tight quarter, and borrowing rates for banks actually came down. But now with the borrowing incrementally shifting more towards the term repo window, we see some amount of leveling off of margins in the next few quarters, partly supported by the fact that liquidity is still expected to remain easy.
Manish, a lot of people believe that maybe IndusInd is already expensive at 500. I believe you got a price target of 600 on that one. Can you take us through the rationale for that?
See, the key rationale for IndusInd Bank is the fact that it is continuing to be an outperformer in terms of the growth that we are seeing. It is growing at well above industry levels. Plus, there is also an improvement in margins that we have seen, and asset quality has been significantly better than industry. We do not see any concern on either of these factors. We expect the premium that IndusInd Bank generates at this point of time to narrow versus the other peers, but that held, it should still continue to give reasonable returns for a long-term investor.
What is your expectation from the PSU banking space? Because we've been talking about Bank of Baroda, for example, all the entire morning, because there's a peer of yours that's upgraded the target price of the bank as well, and we just had MK talk about Bank of Baroda as well. Is that the most resilient in terms of asset quality within the PSU banking space, according to you?
It has been, and it has shown it over the last few quarters, where asset quality has held up much better. Moreover, in terms of the loan mix that we see for Bank of Baroda, the concentration in the riskier segments are relatively lower than most of its peers. So the concern on asset quality are clearly lower on Bank of Baroda at this point of time.
So what is your pick within the PSU banking space in terms of your top picks as well as in terms of earnings this quarter?
So from an earnings point of view, we believe that the PSU banking space in general will be a laggard compared to private space. We are expecting about a 4% decline in earnings for the PSU stocks that we cover, in contrast to about a 16% earnings growth for the private sector space. Within the PSU space, from an earnings perspective, we believe Bank of India is one which can actually show a reasonably healthy earnings growth, which is about 19% estimated for, we estimate a 19% earnings growth this quarter for Bank of India. For the others, it should be flattish to mildly down in terms of earnings growth this quarter. But what we are seeing in terms of public sector banks is not really the earnings which is the focus, but the fact that economic improvement and asset quality improvement will lead to a re-rating, and some of that is already playing out.
And SBI?
SBI is in a similar story. We believe that there will, one of the best things for SBI is its deposit franchise, which remains pretty strong and better than most of its peers as well. We believe that will be the key driving factor over the medium term. We are a little bit more cautious on SBI simply because of the fact that it needs a lot of capital over the next few years to meet Basel III requirements, and we believe that will be a tricky situation even for any new government which comes in, and that will be an overhang on the stock price over the medium to longer term.
Okay, fair enough. Thanks, Manish, for joining in this morning. So that's the view coming in from the IDFC banking space or banking analyst, where he's positive on Axis, ICICI Bank, HDFC Bank, IndusInd Bank and ING Vyasya. But remember,